Well, hello, everyone, and welcome to this edition of Connected by Community, a podcast sponsored by Ballantyne Capital Advisors. We're here today with Amanda McCall from PrimeLending. Amanda, welcome.
Thank you very much for having me. I'm excited.
Well, we're excited too. And as we were joking ahead of time, you gave me an easy name and I didn't have to worry about butchering it. And I think I did okay. So that's good.
You're welcome.
So full and fair disclosure, known Amanda for a little bit of time. I was a little bit younger. She doesn't seem to age, but I do. But in doing that, known in different times of loan processes. And so we want to talk about all that fun stuff. And I'm going to put you on the spot. And we're joking about all that. We're not going to put you on the spot. But our listeners might not know. Tell those who don't know you, kind of, are you from this area? Married, kids, a little bit about you before we jump into the fun stuff.
Yes, absolutely. So again, thanks to you both for having me on today. So a little bit about me. I work for PrimeLending. I'm a mortgage loan originator there. I have been originating loans for 24 years now. I grew up in the state. I actually grew up on Lake Murray in Chapin. Met my husband when we were in college, and right when we graduated college, we moved to the Greenville area and have lived here ever since. So we've moved around in different areas of the county, but have always loved Greenville. We have two daughters, a 19-year-old that's going to be a sophomore in college, and another daughter that's going to be a sophomore in high school. My husband works also in the industry as well. So we just, we love what we do. We love where we live. And I absolutely adore helping people, really move here, learn the town, learn the environment, and, find their dream home, as they say.
So with you and your husband kind of being in industries that are around this, I guess you all have seen a lot of changes through the years.
We have, yes.
So maybe start with that. What's some things you've seen in 20-something years?
Absolutely. So you always hear people say, oh, gosh, my first home was at 18% rate. And, it's just like the old, I walked to school uphill both ways in the snow.
Yeah, in the snow.
Barefoot. It's all these stories that are a little bit inflated, but truly, when I look back through everything that we've been through in the mortgage industry, I truly have seen rates in the nines. This is the highest that I've seen them since I've been doing this. We've seen challenges with the federal government tightening up on restrictions, which automatically is going to eliminate some clients that were able to buy. We've seen huge refinance booms where market has been extremely low. Clients are wanting to refinance. Sometimes clients are refinancing once every year, so we're getting a lot of repeat business on that. We've seen times when, like what we experienced in the housing burst in 08 and 09, where truly everything kind of came to a halt with construction and with new home sales and resales. And, we've really ridden that wave up and down, both of us have. And so now when there's a lot of changes in the market and a lot of uncertainty in the market right now, I can use my experience and some wisdom to kind of look back to say, okay, these are a lot of things that we've been through over the last 20-something years. So yes, this is something new. This is something that we're all trying to figure out how to maneuver and how to work through this and how to succeed. How do first-time home buyers get into the market right now? So it's new challenges, but we know that with the tools and with the experience, we know that we can make it happen. And we like to say, oh, it's because of the pandemic. But right now, this is the new normal. So how do we live in the new normal? How do we work through it? And given the history and experience, I think we know that, as I said earlier, the sky isn't falling. We know that this is going to just kind of be where we are right now. Rates are a little up. Rates are still amazing. Now is still a great time to get in the market, and let's kind of figure that out and how that looks like for everybody.
Yeah, one thing I like that you hit on is even for new home buyers, like we're still in a great rate environment.
Mm-hmm.
I just bought my first home, and I was talking with my dad, and he's like, the same story. Oh, I remember I bought my first home; it was 12%. This is still a great thing. So I think that's one thing that is hard for people to understand. Is you saw it, in the 2s and 3s, and people thought that was the new normal, but really, that's the 5, 6, wherever we are right now. It's still a great time to buy.
Absolutely.
So I guess could you speak a little bit on that? What are rates looking like? Maybe not necessarily numbers, but they are steadily increasing a little bit. Do you still think that's going to continue to go up? Do you think we might stabilize a little bit? Are you still seeing people buy a lot? I guess how's the market looking on your end?
Yeah, definitely. So market has increased. We've seen rates this has been the highest rate increase that the industry has ever seen. So about 2 months ago, we were sitting in the low 3%, high 2% range. Now we're going to be in that low to mid 5% range. And we're talking about 30-year fixed mortgages is kind of what we use as a baseline. So this was something that was unprecedented. We hear that word a lot. It's a word that we really, we're getting kind of sick of because, again, this is just the new normal of where we are. But the truth of the matter is rates should have increased a couple of years ago, and they didn't. So now we're trying to stabilize the market is what's happening. So no, when customers ask me, should I wait and they're going to drop back down into the threes? No, we absolutely do not expect that, nor do we really want that because that's not the market that's not the environment of a healthy market. So right now, being in that 5% range, we really are expecting rates to kind of hover 6% and under for the remainder, really all the way out until 2023 is what we're expecting. So when clients are saying, should I wait? We really are not advising people to wait if what they're waiting on is to find a better interest rate. Because in combination with this is we are seeing house prices increase. And right now they're increasing at about a 12 to 15% amount in the year. So if they're going to wait, and even if rates stayed the same, that same house that was $200,000 is now going to be $215,000 or so next year, and on and on and on. So, that's when we talk about now still a great time to buy. Is because now is the longer you wait, the more you're going to put yourself into a position where you're going to no longer be able to purchase. And I hit on especially the first-time home buyer market because that really is where a lot of the challenges are right now is because what a client could qualify for and feel comfortable with 2 months ago is extremely different than what it looks like right now.
Yes, especially with rising house rates. If you're a new home buyer, that 20% is going to look a lot harder to get.
Yes, absolutely.
And I want to go to that in just a second, but just to put in perspective, because I think people have lost perspective in a lot of things. We see that in our industry, and I know you do as well. 3% mortgage was not normal,
Correct.
right? And the problem is we get accustomed, we change our spending habits, and then that's the new norm. And I don't know the answer to this, and I'm not putting you on the spot, but I'm just curious.
But you are putting her on the spot.
No. What is the 30 or 40 year approximate average? I mean, what's a more normal? Is this a normal? Is 5% actually a more normal rate?
Actually, 5% is still a low rate.
Right. That's okay.
Yeah. So when you look at the average, even over the last probably 20 years since I've been doing this, 5% is still a low interest rate. So when you're looking at the charts and you are really kind of going through and seeing what's happened over the last few years, this is still a very, very, very great rates that you probably could get into. And when it comes to clients, like I had a client yesterday that said, well, I'll just go ahead and get this rate. And she was in that low 5 range. She was like, and I'll just refinance later. And I'm like, well, you don't really need to get into this product thinking that you're going to do this short term and be able to have the opportunity to refinance. There's a lot of benefits to refinance, not just to reduce a mortgage rate. But if you're looking to, this is going to be short term and we're going to get back into that low 3, even the low 4% range and I'll refinance then, we're not really anticipating that. And really what brings those rates down so low is when there is issues in the economy. And so again, back to this being more of a healthy environment and a healthy economy, that's the sign of rates being a little bit higher.
Yeah, and we see the exact same thing. So I really appreciate you saying that. And I think that's part of not knowing what's normal when you're outside of it for so long. And I tell people the same thing. And if you lived through maybe 10, 15 years ago and you saw those higher rates, you'd have more experience with that. So let's maybe shift gears. Some of those folks might be the new home buyers, right? So we've kind of mentioned that a couple of times. And that's a struggle for someone who, whether just out of college or maybe they're on their second job and maybe they're buying their first home, they're competing with cash buyers coming from out of town.
Absolutely.
Whether they're from California or the Northeast and maybe the real estate prices were higher, those folks can come into town and outbid someone and they're buying a lot more house for the money. What are some things that you see between realtors and yourself to maybe help people actually obtain that home when they're in a multiple bid situation? And then how can they work with someone like yourself to be prepared?
Absolutely. So it is very difficult right now. So when you are up against someone that's going to be coming in with no contingencies, which means no financing contingencies, no appraisal contingencies, are able to pay cash and close in 2 weeks. It's kind of hard to compete against that when you do need financing. And when you really do look at it, a majority of the clients need financing, even whether that be financially they need it because they don't have the ability to pay cash, or the fact of they see the tax advantage of having a mortgage. They're able to pay cash physically, but they truly see the benefit of having a mortgage loan. So when you are up against those, you really do need to put your best foot forward. And so by doing that, it means I'm going to preach local, local, local. So work with a local lender. And the benefit of a local lender, because I've been asked this, what's the benefit of having someone local? And there's a lot of reasons. Number one is I am here on the ground, right? So big benefits to that is I know the real estate agents. The real estate agents know me. I know the appraisers. I know the closing attorneys. I know the neighborhood you're buying in, right? In a different scenario, when you're dealing with like a .com company, they have absolutely zero tie to Greenville, which means they have zero reputation that they need to withhold. I value my reputation very highly. And so I want to make sure that I continue to keep that strong reputation that I have. So I'm going to do everything I absolutely can to make sure that this is a very smooth transaction for you, that you're getting to the closing table with no tears and screaming and kicking, right? I want this to be as pleasurable as it can be experience. Something else is that, I'm going to know some slight nuances. I'm going to be able to be very agile and can move very quickly. So if you were to put in an offer, and let's say it was a situation where we're seeing a lot of times to where they are still making it contingent upon the appraisal, but they're putting on there an appraisal gap, which means that they're telling the sellers, okay, I'm willing to spend, to pay $200,000 for this home, but I'm also going to tell you that if the appraisal comes in low, I'm going to spend up to $15,000 if it comes in low. So if it comes in at 180, they're now going to pay $15,000 over that $180,000 appraised value to now get to $195,000. Okay, so that's what they're saying. So when you're coming into a situation like that, and now the appraisal has come in low, and you've got to come up with an additional $15,000, I can move very, very quick to figure out, okay, how do we need to adjust that mortgage? And a lot of times, because unfortunately I'm dealing with low appraisals on a weekly basis now, a lot of times it may mean the payment went up by $5. It may mean that the customer is now having to bring an additional $2,000 to closing versus $15,000 to closing. There's a lot of things that I can adjust and move around. And a lot of times it has to do with the mortgage insurance and how we can structure the mortgage insurance and plug that all in. So dealing with someone that has that experience. So again, with the .com, you're dealing with someone that's going to be in a call center. They may have just gotten their mortgage license 3 weeks ago. The ink is still wet. So they don't know all of this. They don't know how to maneuver and how to make these changes very quickly in such an environment that we're in right now. So just working with someone local, getting that initial qualification done, that initial approval done before you even start looking at homes. Know what it looks like. Know that, okay, if the property is listed at $200,000, you may need to go in a little higher than that to put yourself, best foot forward, to kind of overbid maybe some of these other offers that are coming in. So know what that looks like. What does that mean to you in a cash position? And a big thing too that's going to be different is just because I tell you what you can afford, that may be very different than what you can actually want to spend or be able to spend in your monthly budget. Big thing is I'm working on gross income. You're living on net income. So that's going to be a big difference there. So getting very comfortable with all of that, getting comfortable with the numbers, getting comfortable with what that means if you do put in an appraisal gap, what that means if you've waived inspections for a home inspection or pest inspection. What does that look like for you? So there is a little bit of a game there by playing and trying to make yourself be in a position to outbid maybe a cash or even someone that's coming in, maybe with even a little bit of a larger down payment than you are. So that's what working with someone and having that one-to-one communication and conversation real in depth, because this is a new norm for us in a new environment. We got to figure out how to play in the sandbox and make it all kind of work.
And, I can really attest to this, having known you for a long time and seen some of our clients maybe start with a .com or something, run into some challenges. I real quickly say, hey, you need a professional. And certainly you've been gracious to help a lot of our folks and just a real professional. And I say that whether I'm in front of you or not. And I think you know that.
Thank you.
But it matters. And it might not be but a little nuance, but a little nuance might get someone in their first home, dream home, whatever, and we feel the same thing for what we do. So I know how much that matters. And I think, whether someone reaches out to you or someone else, get somebody local.
Right.
I think with this big a transaction, you cannot afford not to have an advocate that knows those things that you talked about. It's just not the same if they're sitting in California in a call center. Again, like you said, the ink's still wet on their license. So we've seen those things for sure. And I think, the other thing, you have to be able to have a team that's working with you. So that person probably needs a good agent. That matters a lot, even in today's market. And I think I'll say, hopefully we help along the way with a lot of our clients. I kind of want to ask a question here. Sometimes a financial advisor has to get involved and help document some of these things. Clients aren't always, the best at keeping all the records or they need a little help. And I'll give a quick example and I'll ask a question. So we have worked with a lot of retirees. And how does the retiree get a mortgage? Retirees still want houses, and retirees a new thing. A lot of our clients might retire at 55 or 60. They've done well for themselves, but they want to keep a mortgage for whatever reasons. It makes some sense for them. How do they then qualify for that mortgage? And then what kind of things do you come to the financial advisor to help support that? Because we're kind of helping them with that income structure, and there's maybe some additional documentation. And in fact, some don't even know they can get a mortgage. So maybe talk through that process a little bit for the retired market and what they might need to do.
Yeah, absolutely. So this is something that you and I've dealt with on quite a few clients. So whenever we're looking at income for someone that's retired, so if we're taking just the basic income, let's say we're going to start with Social Security and pension. So if they are receiving that income tax-free, then immediately I'm going to be able to gross that income up 25%. So if they're not having to pay taxes on that income, we can take that and gross it up 25%. So that immediately is going to help a little. But a lot of times that's not enough to qualify for the kind of mortgage that they want. So one of the things that we're able to do is we're able to take money that they have invested in the market, and we're able to get them a distribution on a monthly basis, and we can use that distribution as income. Now, a couple of caveats. That distribution has to be pushed out to them, not pulled, meaning they can't go in and just every month say, okay, I want to pull out this much this month and this much this month. It has to be an automatic set distribution that comes to them on a monthly basis. And I can help them kind of figure out what that amount needs to be, contact you directly, you and I can kind of talk that through and work through it. And that immediately, as soon as that starts, we can qualify them on that income immediately, get them closed on the home. And then later down the road, if they want to choose that distribution amount a little bit differently or make some adjustments with you, they absolutely can. But that is definitely money that we can use. And that's how I help a lot of my retired clients.
For the retirees, is there a length of time you have to have that distribution set up before you can, kind of qualify them? Or is that like, you get it set up day one, it happens once and you're like, all right, we're good to go?
Absolutely. Yeah.
Okay.
So as soon as that money has been set up and deposited into their account, I can then use that as a recurring monthly income. And then once we close, that mortgage is closed and done. Yep.
Perfect.
Yeah, and that obviously with what we do affects a lot of our folks. So I know that's an important message for them to hear. Let's talk about one other market. Let's talk about maybe, because, and I don't even call it a luxury market, but it's called, the jumbo market is the term that's used. That's probably affecting more people with house prices rising. And I don't know, and certainly you're going to know those limits better than I, and you'll talk about them maybe in a second, but the government may not keep up with those limits as well as the rising prices. So whether it's a rising price basic home or somebody's fortunate enough they are able to buy a $5 million house, what are those limits? How does that work for maybe the client that's buying a little higher price house? What do they need to take into consideration different than that first time home buyer?
Yeah, absolutely. So what you're referring to is like you said, the jumbo. So a jumbo loan. So anything that is greater than $647,200 on a loan.
That used to sound like a lot.
It used to sound like a lot. And for a long time, it was $417,000. So that tells you how much it has increased over the last few years. But $647,200 is the loan limit. Okay, so anything above that becomes in the jumbo world. So really the big differences are you're no longer dealing with Fannie Mae and Freddie Mac. These are the two entities of the federal government that provide financing for loan amounts less than $647,000. Once you go above that, then you start working with more of your private investors. So that could be local small businesses that are going to hold on to it. That could be larger conglomerates like Chase. Wells Fargo offers kind of some tools in that realm. But so those types of products are open to every lender. And so that's when we start having the ability to kind of shop that around, right? So we can take a look at all the different caveats and all the different loan requirements, different loan to values, different credit scores, different reserves. Reserves are money that's left over after closing and what you have kind of invested and what you have in your savings and checking account. But it's a lot different. You definitely need to have much higher credit scores. Down payment requirements are different. You're not going to be able to only put 5% down. Typically, you're going to put 10, if not 15% down. And in order to get the best rate available, you're going to need to come in with at least 20% down. Job stability is going to be very different. Someone that has been maybe in the last 5 years has held 3 or 4 different employers. They've kind of switched around a lot. Their income has fluctuated, which has led to their savings account fluctuating a lot. That may be a bigger risk, and that may be a little bit more challenging to work with. Customers that are self-employed, there's going to be a lot more requirements once you start getting into that range. One of the things that has recently come back, and this has happened over the last 2 months, is that we started stacking mortgages again. And what that means is that in keeping the first mortgage amount below that $647,000 limit so that we're back into that conforming loan amount. We're able to play in that realm, have a lot more forgivenesses. And then with whatever amount they need to bridge the gap, we put it on a second mortgage. So they have a first and second mortgage combination. Another great benefit of that is that second mortgage is going to be, let's say, $100,000 on that second mortgage. And they've got $600,000 on the first mortgage. Well, now you've got a much smaller obtainable loan on that $100,000 that you're able to chunk down and pay it off a lot easier. And then if we put it on a line of credit, then you're actually, even after you pay it down or pay it off, you're able to pull it out again and still use some tax advantages for that money as well. So there's a lot of different, more creative things that we really have not been doing prior when the market was so low that we are kind of getting back into.
One other question I had too, now that we're talking about stacking mortgages, is there any other products or strategies that you're using right now? I know we talked a little bit about an ARM. Is that kind of starting to come back? Can you talk a little bit about those?
Yeah. So now that we are seeing rates up a little bit, again, still great, but they're up a little bit.
Great.
So we're trying to figure out what that new normal looks like. So adjustable rate mortgages, also known as ARMs, those definitely something I have not said in years. So I'm definitely saying it more frequently now. So an adjustable rate mortgage just means that it's a 30-year term, but the rate is only guaranteed for the first few years of the loan. Typically, it's either fixed for 3 years, 5, 7, or 10. And then recently, we started seeing some 15-year fixed options as well. So the longer you fixed the loan, the higher the interest rate. So on average, a 3-year ARM is going to be at a little bit of a better rate than a 5-year ARM. So these are really great products for clients that know they're only going to be in that mortgage for a shorter period of time. For example, this will be great for someone that maybe is going to be having kids going off to college and they know that they'll probably be downsizing after they kind of are empty nesters. Somebody that relocates in and out a good bit, so they know that they're going to be relocating out. We have a ton of clients now that are remote. So this is a new thing as well. So they're learning that they can live anywhere in the country, doesn't have to stay where their job was. So they may only want to stay here for a few years and then go and travel and stay somewhere else. So there's a lot of advantages that the ARM products, the adjustable rate mortgage products bring. There's a little bit more requirements as far as down payment goes. So I'm not really seeing ARM products being a good advantage for a first-time home buyer that's looking for more maximum financing, but it does allow some of those move-up buyers some flexibility on how to structure that mortgage.
I think on the ARMs, certainly in the last several years, rates have been so low they didn't make any sense.
Correct.
But back in the old days, 3 years ago, 4 years, whatever it was, when they did, I think they got overlooked. And I'll say this, and maybe it's because I've been a little bit of a mover around, and it's been more, hey, you get a starter house, you move to this house, whatever. I think some people get romantic about a house and that I'm going to live here and it's my dream house. I've learned there is no dream house. Being an older, I say an old dude, I say to these young guys, right? It was a joke in our office, I'm old, but I think we get romantic, and this is, I don't know, there's no perfect house, there's no whatever, but even if it's local, I mean, we love this area. We have no intention of, We had no intention of moving. We've moved around town, right? In fact, we've moved 4 miles down the road, and less than that. So, and when I've looked at these things in the past, again, several years back, let's say you did a 5-year ARM and you lived there 6 years. It's not the end of the world if you get one adjustment. That's still, and in fact, you might get 2.
Correct.
And if it went up the maximum amount, still be better off than if you'd gotten the 30 in the first place.
Or just break even.
Or break even, right? And it maybe allowed you to do what you wanted to do. So curious, I don't know if there's any stats out there, if you know approximates. What's the approximate time someone stays in a house that gets a 30-year mortgage? In other words, the intent was 30, but what's the average length of a mortgage that's supposed to be 30 years?
7.
So that right there, so if
It's 7 years.
I knew it was low. I didn't know the number.
Wow.
So so if on average we're taking 7 years, what's wrong with a 7-year ARM? Again, I'm not advocating running out and getting one.
Correct.
There's none of this is advice. We'd all have to know your personal situation, but I think they may be overlooked tools.
I would agree.
At certain times.
I definitely would agree. And there's a couple of things I think that play into that. And that is coming off of what happened in 2009 when the market crashed. And on that point, there were a tremendous amount of adjustable rate mortgages out there that were negative amortizations, interest-only ARMs that were out there. So it scared the market. So it really did put a very bad stigma on ARMs. And so there was almost an immediate halt to all adjustable rate products because they were looked at in a negative light. But when you truly look at, and when we say a 7 years is the average of someone being in a 30-year mortgage, that doesn't mean they're selling. That just means they're maybe refinancing. They're doing something to that mortgage to pay it off. So when you really do sit back and look at it, adjustable rate mortgages can make a lot of sense. It's difficult right now because the reason, a big reason of why there's such a supply and demand issue. There's a lot of things that go into it, but a big reason is because of all the first-time home buyers. That whole age group now that is coming in, they truly, it's hard to visualize how long am I going to stay in this house?
Right.
And so when someone's coming into the market, and you said you just recently bought your first home, so it's hard to say, oh my God, this is the biggest thing you've ever done in your life. Why would I sell this in 7 years? I would never, I couldn't afford, I will never be able to afford anything more, or I'm already struggling. There's a lot of things that go, wow, this, I don't see me ever getting out of this. So there's a lot of fear, a lot of parents educating their kids that no, you want a 30-year fixed. You never want to pay PMI. You need to only work with X company. There's a lot of that they're getting as well, that sometimes just information really is, they just don't know all the information. And so
I actually misspoke. So I can speak on ARM. I actually had one. So I'm on my second home technically.
Okay.
The first house that I bought right out of college. I had put 20% down. I worked with a local bank. And the only thing I could get approved for, because I had 3 months of work history or whatever, was an ARM. So I had a 5-year ARM. And I literally stayed there for like 6 months. I just fixed it up, sold it because I knew I didn't want to live there, and then bought the house here. So technically this is my second house, but the only house I intended to stay at. And then this house I got a 30-year fix, obviously. So I can personally attest to using the ARM. Might not have been the smartest thing said. That's not advice by any means, but that was actually the only product I could get approved for. So I kind of used it for my advantage. I stayed there for 6 months, like you said, not very long, sold it. And then now that when I got my second loan, rates were good and I had a little bit more work history, got approved for a 30-year fix, worked out great. So personally I've used one myself, but obviously not giving advice either. But
well, and I think, and I kind of alluded to it with, sometimes we get romantic with buying the house or whatever. I think a lot of times it's hard to know when you're young, or even as you get into your 30s or 40s, how much life's going to change. Whether it's you hadn't had kids and you have kids and the kids get older. I'll throw myself there, as my kids got older, what they did changed. When they were younger, they're out in the yard. Right. Then they didn't go out of the yard. They were playing video games with their friends, right?
Now they want to pool.
Yeah, and they want to pool or whatever. So, or they want to be at the lake so that's that's a different podcast.
Yeah.
A podcast on how expensive kids are. Maybe we'll have to have a big table. But, it changes your wants and needs. It's like, why do I have this big yard? The kids aren't out there anymore. Maybe I don't want to be cutting the grass. They're not here anymore. So I think that plays into, the ultimate mortgage decision as well.
Absolutely.
One thing I did want to speak on, I know we're running out of time, is I feel like over the last couple of years, especially with rates being low, we've seen like a huge refinance boom. Are you still seeing that? Are people getting a little more scared now that the rates are going up? You know, if they locked in a super low rate, they're not wanting to refinance at a higher rate. I guess, can you talk on that a little bit?
Yeah, definitely. So that I did do some research on.
Okay, great.
I figured that question was coming. So what forecasters are expecting is that the purchase, so the new purchase origination loans for a new home buy is actually going to continue to increase. So it will increase throughout 2022 and then again in 2023. So they're expecting, like 2021 was about 1.9 trillion. In 2023, they're expecting it to be about 2.2 trillion. So that's kind of the growth that they're expecting over the next few years. Now, the big difference is refinances. So when a refinance in 2021, I forgot the number, but it was like 5 trillion. I mean, it was insane how many people were refinancing and then the volume that was there. In 2023, it was down to like 1.2 trillion.
Wow.
So there's going to be a significant drop. Now, what that is going to bring into the market is you're going to see a lot of loan officers get out of the business, a lot of mortgage companies closing their doors. And that's because those are banks and institutions that focus solely on the refinance volume. And that's something that I've strived myself with throughout my entire career is I only do refinances for past clients or direct referrals. I want to stay there for my purchase clients, for those clients that are coming back to me on a repeat basis, because I do want to be someone's lifelong lender. So I'm not out there advocating for just Joe Schmo to call me for a refinance, because I want to be there for when Joe needs a purchase and when Joe is there for me to educate him and help him as his family grows.
And then Joe needs a lake house and a beach house.
Correct. and then Joe needs to refinance them. That's what I want. And that's where I think why I've been able to grow and be in the business as long as I have is because I am here to truly, these are not transactions for me. These are families, these are lives, these are my clients. You know, I want to be that go-to person for them.
And I think that kind of brings full circle to some of the stuff you talked about, whether it's the .com lending company there, or even some local people that said, hey, mortgages are hot, I'm going to get in the business.
Mm-hmm.
I think it's not just local, but it's experienced local that survive, because the mortgage industry, like all industries, goes through cycles. And if someone hasn't built a business to be able to weather that, we had an experience of a client that went through it where someone was getting out of the business and it kind of blew the whole loan up for the client. So it can create a lot of heartache if they're not working with a professional and then a team behind that professional. And I know PrimeLending gives you a lot of resources there, to help you. So I think that's another advantage.
Yeah, absolutely. I mean, I truly can say that PrimeLending is there. They are one of the companies that I work for that really remembers who the customer is. You know, why we're doing what we're doing, and it's for the client. So the things that I've seen them be able to do to get to the finish line, I have never seen with other companies that I work for. It's absolutely phenomenal.
That's awesome. Yeah, because I know some of the big banks, we won't name them, but they can be a little more bureaucratic, shall we say?
Absolutely.
Even the big local banks.
Even the big,
absolutely.
Just because they're local doesn't mean they're local.
I agree.
You know what I mean?
And the way I describe it is like a big cruise ship versus a nice luxury yacht, right? The cruise ship, it is going to take a while to make a direction change. The yacht is going to be very, very agile, and we can make a lot of quick moves.
I'd rather
fast.
be on a yacht personally.
Yeah, me too.
Yeah. A lot more.
I have one more technical or business question
Okay.
I want to ask, I think. And I don't know, I don't want to have to get into the weeds with this, but how has regulation changed? Because it's constantly changing.
Mm-hmm.
Obviously, as someone who's in the business can know. But what might surprise someone that hadn't gotten a loan in 5-10 years?
That's a good question. So 5 to 10 years, we have seen a lot more relief than we have for tightening regulations. So before
Send that this way.
I know. But that is because of the regulation changes that came with Dodd-Frank. So when the pendulum swings and when it started to swing in 2009 and 2010, I was documenting everything. And what was difficult with that, and this I think is the biggest challenge that I have heard, is whether the customer has a lower credit score and is a lot more credit challenged, not as much money to put down, versus the client that has stellar credit and is coming in with a larger down payment. Documentation-wise, it's about the same. And so it makes it a lot more challenging for these clients that really have the stellar credit and the bigger down payment to try to understand, why are you needing all of this from me? I can pay this house in cash. Why are you having to ask me why that deposit was deposited into my bank account or why I moved that money over there? And the reason is because of all these federal guideline regulations that we're having to adhere by. What we're starting to see now, though, is some of that coming back and kind of coming and changing. And that's actually going to bring me to my website and one of the things that I'm kind of going to steer people towards. So the reason that I educate people and I want to talk to them and have that real detailed conversation with them, but when they're ready to apply for a mortgage, I'm really going to advise them to go to my website and to apply. And the reason that I do that is because my website is very intuitive. So when a customer starts filling it out and they're going to put in the information of where they work, they're going to go in there and they're going to put all that information. I've worked at GE or Michelin or where have you. I've been there this long. They're going to put in some HR information. Well, my system is actually going to go out onto a national portal, and we're going to be able to pull their pay stubs and W-2s as long as their employer reports to this. Same thing with their assets. So if they bank at Bank of America, whomever, I'm actually going to be able to go in and pull their bank statements from their bank account. So what ends up happening is when that application comes to me, the client has filled everything out accurately. I now have all of their income information, their W-2 information, their bank statements. Sometimes I'm actually able to run it and get a full approval just with that. And all the customer has to give me is a driver's license. Now, if the customer did the application with me over the phone, I'm not able to do all of that. So that's why this is where the technology comes in. And this is where the government is really saying, okay, I'm getting the same information, but I'm able to pull it from these online sites and from these secure encrypted sites to where it's a lot easier on the customer side. So yes and no. Yes, we do have a tremendous amount of regulations that we have to follow. Okay. That's not changing, but the way that we're able to get some of that information is definitely becoming a lot more user-friendly.
That's
cool.
awesome to hear. Mm-hmm. I can't report the same on the investment end. So we have a lot. We are constantly purchasing technology to combat regulation. So it's a little bit different, but that's okay. That's actually pretty.
That's really neat.
That's actually
cool.
pretty exciting.
That's a cool website.
So, absolutely.
So that's awesome. So I think that answers most of my technical questions, but I know Cameron wants to ask our signature question.
So the signature question is, what makes you tick?
Oh, good question. All right. Honestly, I would say it's not a lie when I say I love what I do. And I love talking with a client that truly does not think that they can make this happen, and I'm able to make it happen. I think so many people get blinded by, I have to come in with 20% down, or I have to stay at this monthly payment. I can't exceed it. But when I step back and I look at the full profile, and this isn't just for first-time home buyers. I deal with a lot of clients that are buying their third, fourth, fifth home. And I'm able to take that money and say, you know what? If you take this $60,000 that you have that you want to put on a down payment, and you actually only put $20,000 as a down payment, and I use that other $40,000, and I consolidate and pay off all of this debt, this student loan debt that you've been holding on to for 20 years, that car payment that you're in, that credit card that you're maxed out on. And now all of a sudden, yes, your mortgage payment went up by $200, but your overall debt, I just decreased it by $700. So, and then all of a sudden, where I'm looking at, they're maxing themselves out to buy this home. I've now put them in such a much more comfortable position. So it's things like that. That's really what makes me tick, is really truly getting down and helping these customers. Because again, this truly is, I want to be their lifelong lender. I want to be their go-to person because it matters to me. Absolutely.
Awesome.
Yeah, and again, I can attest to that. And you do an awesome job, so we thank you for what you do.
Absolutely.
So for those folks that don't know you and they want to find you, how could they reach out to you, apply for a loan, or find out more information about you?
Definitely. So I am all over Facebook and Instagram. It's the McCall Hannell Fox team. And you can find my website directly at AmandaMcCallHomeLoans.com.
Well, Amanda, thank you for joining. And
absolutely. Thanks for having me.
Always learn a little information, so that's a good thing. And glad to hear regulation isn't killing you. So
no,
that's
not today.
Yeah, I understand. Well, thank you everyone for joining our podcast. Again, we're connected by community. Go out and find us on Instagram, Facebook, and all the various social media platforms, or your favorite podcast platform. Until we see you next time, go out and make our community great. Thanks.